doors closing, I think we're ready to go. So hello everyone. I hope you had a good lunch. I think my first role is to make sure everyone stays awake in the first session after lunch. So I'll definitely try and do that. For those of you who don't know me, my name is Jonathan Knight. I'm the co-founder and CEO of QMe. QMe is an online rewards business. One of the things we do is offer our users surveys so they become panelists. We offer QMe as a site that offers instant cash rewards, and we have a mobile app and a desktop app. So you might well see us on the other side of if you're buyers of surveys. Our users will hopefully be filling them in. So I spent slightly more than 20 years of my life in investment banking. And my job, I was a derivatives trader. And I worked, as I've mentioned to a couple of you, I worked on Wall Street, I worked in Tokyo, Hong Kong, and London. And I saw a huge amount of change in that industry during my time there. And I think what is very interesting about what happened in investment banking, and particularly the trading businesses, a lot of the same things seem to be happening in the survey business. And I think there are a lot of parallels to be drawn, and I hopefully will tease some of those out through the session. And please feel free to interrupt or ask questions as we go along. So that is the New York Stock Exchange on October 19th, 1987, which is now known as Black Monday. And when I put this deck together, I was obviously being very prescient because we're in the middle of another market crash right now. I should never put this picture up on the slide ever again. So the Dow index fell 20% in one day, which is still the biggest percentage fall. But there are a couple of things on this slide. I'm going to see if I can highlight them with this. There's a couple of things on this slide I wanted to highlight. It wasn't just the hairstyles from the 80s, which is great. This guy here is actually in the process of trading, and he's trading by shouting at his counterpart, who is somewhere down here, I would guess. So it's an open outcry market at the time. And when they've done a trade, see all these little bits of paper, these trade blotters, they write them down. And if you were a trader at the time, one of the major skills was being able to add up in your head what your position was. And it was amazing how many people weren't able to do that. So these people on the floor were chosen for a very specific skill set. They had very sharp minds in terms of mental arithmetic and keeping calm, and transacting without making errors was the main thing that they needed to do. So at the time, that was the user interface. If you wanted to look at stock prices, you looked in the back of the paper. There were pages and pages of stock prices, and then every now and again a dramatic situation would happen, and they'd put the market on the front page. But that lasted a day or so, and then the world went back to normal. And at the time, this is a British phone. I think they were actually slightly different here in the States, but at the time, your route to information was that. And if you were a professional, you would call down to the floor and you'd ask the traders what's going on, and they would fill you in, and then you'd repeat that on the other phone that you were holding up in the other hand to your client. The market that I started working in London used to close for business on Friday lunchtime. And the reason why it did that was because there were so many errors. People had written down the wrong numbers, people had written down the wrong prices, they'd traded with somebody different to the person they thought they'd traded with. So we spent all Friday afternoon calling all the other banks and running down the list of trades from the week, trying to figure out what had gone wrong. And it was always a lot. So the error rate was huge. And there's a motto in trading: if there's an error, it's gone against you. You will always, you never made money on errors. It always cost you money. So think about the costs of that. All the way down the chain, passing information from one person to another on the phone or shouting in a marketplace. The number of errors that always cost you money. It's a very expensive business to run. So to this day, and I occasionally come out with my family with trading language, and they look at me like I'm very strange. I still say half 100. I don't say 50, because it's very easy to think 15. So those are the tricks you had to use. Try and reduce the error rate as much as you could. Okay, so this is where we are now. Nearly every exchange in the world looks like this. The only place really left with a floor is the New York Stock Exchange, and actually that's as much for theatre as it is for reality, because huge volumes of trading go on automated markets outside there. And you can trade at millisecond intervals. Markets work differently in different places. Tokyo is slightly different from London and slightly different from New York, but basically they all run the same way. People enter orders and they're automatically executed at very, very tiny fractions of a second. And I used to spend my life in front of one of these. That's a Bloomberg terminal. So your user interface, dramatically different. Look at the volume of information you can get compared to what it used to be. At best, you'd have a phone, or possibly you'd read the ticker tape. Now you can see prices in different markets. There's analysis. So if you look here, you can see what different markets have done over time. There's news flow. It's a huge volume of information. So there's a richness now. We were almost looking through a letterbox before, and there's a richness to the data, and I think that's quite important. And you can execute trades using terminals like this pretty much in real time. And if you're a retail investor, that's what you get. You can trade on a mobile phone. People have said mobile, and I've heard other people say, God, never mention mobile to me again. But the reality is we all carry one of these things. And again, look at the richness of the information you can get versus what used to be available. And a lot of that is powered by analytics that just run automatically in the background. So banking has moved. And the words that they use are slightly different, but the word in banking and trading is low touch. Everything wanted to be as low touch as possible, and then even better than low touch is no touch. So that means that the orders will pass all the way down the chain, be executed, and be reported all the way back with literally no intervention. And I'm going to touch on this a little bit later. That actually gives you more capability, apart from just the speed and the difference in error rate. Because suddenly you can do almost totally new things. And so here in the US, I know, and definitely in Europe, there are robo-investors now that will rebalance your portfolio all the time. There are tracking funds. All these innovations just weren't really possible in the old world, because you just couldn't afford to do them. Okay, actually, we're a bit beyond that, really. We're a few years past that, but that's... So this is our new world in the survey business. So surveys are placed, somewhat automatically, sometimes hand-entered, but they do flow through APIs. And they get sent out to the respondents. There are lots of different pieces to this, but automation has already started to bite. But unlike financial markets, a lot of these are still one-to-one connections. and that has limitations on what you can actually achieve. User interface, that's changed a fair bit. So this is the QME app, and we match our users to surveys. We try and present as interesting a view of them as we possibly can to engage them. We try and tell them something a little bit about what they might be getting into, and we try and run this so that they can do it at their own leisure. They're on the bus, they're commuting, they're in a coffee shop, 24 hours. And finally this, I've used the wrong word because I should have used the word platform. So
things change rapidly.
I panicked yesterday in the state of Lucid when Patrick started talking platform and I'd made this about marketplaces. But we're sort of in the same place. This, I think, is the most interesting piece of all, because what a marketplace does is connect multiple partners, multiple players on each side. So you have a many-to-many connection. And that makes it much more like the financial market. And that's really why I and my company got interested in the survey market, because we felt that we could apply our skills to this new world. Okay, so what happened in banking and what might happen in survey? So I think there are the key features of both industries are similar. You have marketplaces, you have electronic access, you have automatic execution, you have end user participation, you have the ability to go low touch all the way through that chain. But that drove really, really big changes in the industry that I was in. It drove changes in the way the companies were set up, it drove changes in the jobs that people did, it drove changes in the mix of people that were in those businesses and the skills that were in demand. So those, I think that's the so what. Well, the first thing I want to say is actually I think this is a really, really good news story. Those huge changes that I think are coming, whether we like it or not, just because of the way the industry is now moving forward with automation, I think are going to drive really great things. I think automation is the key to what we do, and I think will be the key to what a lot of people do going forward, because for two reasons. It increases your accuracy, so your error rate goes down, and it reduces your costs. But it's critical, and I think Patrick talked about this a little yesterday, it's critical that extends all the way up and down the chain. Because if there are breaks in the chain, you just lose the value that you just tried to create. So to give you an example, in the late 80s when I worked at Goldman Sachs, in every market location around the world, so the big markets, New York, London, Hong Kong, Tokyo, there were hundreds of equity traders in each location. And many of them spent their day filling orders from clients one by one on the exchange. If you go into a trading floor now, I think there are 4 or 5 traders in each of those locations. And they spend their day monitoring the machinery that is actually doing all the work. So if we remember our guy who was executing the trade on the floor, he had a certain skill set. And he didn't actually have the skill set to monitor sophisticated machinery. So he wasn't that happy with this change. But it came whether he liked it or not. So the jobs became strategic. They became monitoring the trading engines, talking to clients, managing the risk, it became much more about much higher value and about running your business. It also became critical to root out causes of errors, because errors cost you so much money, and they cost us so much money in this business still. So just to give you an idea of what happened and why automation is so important and what I think is going to happen to this industry going forward. So this is a chart of trading a share on the New York Stock Exchange, and what does it cost you? And you can see it's interesting that it was actually going up until about 1980 or so. But that is an 80% reduction between 1980 and 2000. So if you think about what is that? That is the revenue that your trading business is bringing in to transact one share. 80% fall. And subsequent to 2000, it's gone down another 50%. So that's probably 90% in total, if not more than that. So that's the type of change that can happen. So if you were a bank faced with that, you had to automate. There was no alternative, because you just couldn't afford to run the business with hundreds of people.
What happened in, 1930 obviously is coming out of the Great Depression.
Yeah.
Just more.
This is really interesting. No, this is the cartel of bankers. that is bankers basically being in a club and going, we're going to have fixed commissions, and by the way, we choose what they're going to be, and we'll put them up this year. We want another yacht. But deregulation started to happen, right, in the 80s, and so commissions eventually got deregulated here first, and then in London the same thing happened. The same thing happened everywhere, basically. And at that point, they lost control of the members of the floor lost control of the market, and then it became a self-feeding thing. You couldn't really stop it.
But could you also argue that because the technology has become scalable and more people can enter the market on a consumer type level versus institutional level, so where margins might be down, revenue can still be.
Exactly. Hey, you're ahead of me. Exactly. You know what? I love that.
Slide didn't say that margins are down. It said the transaction costs.
Transaction costs were down.
That's the cost of doing business.
That is that's your revenue per share. Mm-hmm. But look what happened in response to that, and that's why this is, I think, good news, right? So you had a massive increase in volume.
What percentage increase is that?
So from 1980 to 2008, so that peak just before the crash, that's 60 times.
Is there a data point on here where things like E-Trade came into the marketplace?
I tell you what, the problem with this chart, and I was really struggling to get the data. So there probably was a fall after the crash in 2008. But the other thing that has happened is a lot of trading has moved off market. So actually, I think it probably dipped, and I suspect it's probably up here now, in reality.
Because this is just New York Stock.
Because this is New York Stock Exchange, as an example. So, but stuff has moved to Archipelago and all these other guys who've set up markets since then. So I think you would expect probably volumes to be up 100 times by now. So if you think about that, what's net that means is actually 10, 20 times more revenue in the business than there used to be. But obviously each trade is at a much tighter price. And that has implications for your business, right? So I guess the first implication is you don't have to worry about the guys getting paid their bonus. They're going to make their number, but there are going to be a lot fewer of them, and they're going to have to be more efficient.
And what's the error rate? How much has it gone down?
So that's really interesting. So the error rate. So when I started, the error rate was about 8%, and it's now, I think, 0.08%.
Mm-hmm. Yeah.
And again, that's really crucial, right? Because it's the errors that really eat up your time. So in our business, it's a survey hasn't completed properly. We've got to call the provider, and you've got to have 2 or 3 people investigate, and that's a very expensive thing to do. So really the real win is actually the error rate as much as the transaction cost. Okay, so that was the virtuous circle. If you were one of the lucky or happy banks that could invest in new technology and become a low-touch provider and move forward with this, you ended up in that virtuous cycle where your automation led to reduced costs, volumes kept going up because it became easier to trade, and that led to higher revenues. And part of that volume increase was not just people doing more of the same thing. It was, I'm going to run an ETF, an exchange traded fund, which requires automated trading of a whole different slice of different stocks. Or I'm going to run passive investment, which so new things became possible, which continued to drive the volume. It wasn't just more of the same. And I think that's a really significant point for survey as well. I think we've got to be looking for what can we do with this level of automation. So what happened to these businesses? Oops, I skipped over. So we've talked about this a little bit. The job roles changed quite significantly. So of those 5 traders, 3 of them will be pretty tech savvy. You know, they might have come out of the technology department as much as out of the trading business, because they had to be to run these systems. So the manual tasks got stripped away, all those boring operational jobs. The first thing that Goldman did was shift them all to Jersey, and then they got rid of them all completely. Your people need to can end up doing much more interesting things. They can end up doing sales jobs, or they can end up doing more strategy, data analysis, much higher end stuff, because they're not having to just operate the business anymore. But you did have a big upfront cost in tech. And at the time, technology was super expensive. You know, we had to go out and buy a mainframe from IBM for millions and millions of dollars. And so the cost of being in the business just increased, and it was a fixed cost. It wasn't related to the number of people you had. You just had to pay it to be in the business at all. So you had this fixed cost that you couldn't really reduce, because if you reduced it, you became non-competitive. And you're constantly trying to reduce your variable cost, your transaction costs, as much as you can. So this is what happened in banking. So this is a slide from 2016. It's a JP Morgan report on the different investment banks. And it's a little hard to see, but I'll sort of walk you through it. These red boxes are the top 5 in each market. So the left-hand side is fixed income, the right-hand side is equities. When I started in the business, there were probably 20 decent competitors. By 2016, these top 5 had over 50% of the market in each of these businesses. And guess what? They were the same people. The only people who they've circled the ones that have switched out. Deutsche Bank and Credit Suisse flip over. But the others are JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America. So because the cost of the software and the development and running these quite expensive systems went up, it forced concentration. And if you're one of these guys here at the top, the only way to compete was to specialize.
All of these models you're showing all have a limit. Every single model you talk about has a limit. What happens when fintech gets to the point where blockchain is doing this trustless trading, you don't need them?
Then the pressure becomes even greater, right? Then all they can be is advisory or strategy. So that crushes that cost to zero effectively, doesn't it? And then they have to make their money in other ways. And I think that's just a sort of inevitable downstream thing that can happen. And they've already moved an awful long way, right? Because, they will advise you how to build your portfolio, but they'll use AI a lot to do that. But they will, or suppose you're a sovereign wealth fund and you have certain portfolio of assets. They'll say, well, you shouldn't have that portfolio, you should have that one, and we'll tell you how to get from A to B. So that's what happens. Your people have to be able to do that stuff and not the operational stuff.
Well, and with the idea of blockchain, so the banks are actually investing heavily in blockchain to shore up their position because they already have economy of scale. And so where there's disruption and they have an advantage, so for example, this week, most of the major banks decided they're no longer going to allow you to use your credit card to buy cryptocurrency. So in effect, stopping the ability to buy cryptocurrency for people who are not large-scale investors.
Yeah.
So there's lots of ways that middlemen continue to hold their position because they have the economy of scale, and they still get the advantage because they can build up while other people can't.
Yeah, and they're probably playing for time as much as anything. Right? They're playing for time. They want to keep in the game, and all these different businesses have blockchain.
At some point, though, Ethereum is going, somebody's going to build a platform where they just license it out and let the issues do the work. You're not going to need that. You're not going to need a bank.
In theory.
In theory.
Right.
Yeah. Okay, so that's been talking about automation really as a whole. Right? APIs give you that, and what does that do to your marketplace? I think the other really interesting thing that is happening is around transparency. And I wanted to give you an example for the financial markets, and bear with me, it's a little bit, not everybody will have seen this, but I wanted to give you an example of what can happen when transparency really changes in a market. So this chart is a chart of correlation between different world markets, and I'll explain what that means. So basically, if the market in London is up today, if you have a high correlation like 1, then New York will be up as well. If you have a low correlation, there's basically no relationship between those things. And what's really interesting about this is look at all the way through to the mid-90s, markets didn't behave in the same way. So London could be up and New York would be down, or the other way around. And why was that? So it was because it was actually quite hard to find out what was going on in other markets. You know, if you're just faced with the newspaper, or you know, where do you get that information from? The guy on the stock exchange floor, he didn't want to come in the morning and find out what had gone on in Tokyo and Hong Kong and London. He wanted to talk about the game. He didn't care. And you could see what that meant. These markets just weren't coupled together at all. But look what happened from the mid-90s. Suddenly the world has completely changed. Bloomberg terminals became common. People used to see the information. You couldn't avoid it. And if you were the guy who didn't know what had happened overnight, guess what? You lost money. You were forced to change your behavior. So what can we think about in terms of what's going on in sample right now that might be related to that? So here's one of the pictures that we look at, and it's a lot of green dots. It's a lot of green dots. So what is this? So this is a chart, and the data is for the month of January. So this last month. This is a chart of CPI against IR ratios for all the different surveys that we saw in the marketplaces in January. And the size of the spot is how many survey starts we think there were, and that's a bit of an estimate, but I think we're roughly, we're in the right ballpark. And this data, just to say again, this isn't me, this isn't my business, this is the marketplace. So this is a combination of Fulcrum, and we put Sint in there as well. So we blended the two together. So it's all over the place.
Where's the correlation there?
There's no correlation. It's all over the place. It's all over the place. What does that mean? Why for a 90 IR survey, I guess everyone knows IR is the incidence rate, so it's how easy it is to get respondents. Why does that price go anywhere between 50 cents and $10?
Length of interview, possibly?
It's supply and demand.
I think both of those are true.
Lack of prices.
But actually, if I plotted anything, it doesn't matter what I plot. I mean, I picked IR for the sake of picking something. It's all over the place. There's really, it's very inefficient. So, and it's because people haven't yet started to look at this data. And Patrick talked yesterday about the reach system. I suspect we'll start to see this change. We obviously already look at it for ourselves internally, but there's very little consistency between prices and the content that goes up in the system. And so on the one hand, that's opportunity. On the other hand, it's price inefficiency. And if you're a buyer, you sort of want to know what's the right price to put something up at. And for me, on the other side, we're selling our panelists. I want to know which surveys look the most attractive for me to put people into. So you can see there are some patterns here. You can see the high price ones attract a lot of starts, I guess, as you'd expect. But weirdly, some of these high-priced ones don't attract. I mean, these might be the classical 1 hour long surveys, which nobody wants to do, right? These ones up here, right? No one can face doing those. It's interesting that the really tough ones, people are trying these. These ones with very low IR rates, people are actually attempting to put their users into them. The other thing to notice, you see how there are vertical stripes? So that tells me, and I'd love to hear any other thoughts on this. That tells me that these IR ratios that people are putting in are sort of, because they can't come out all on 10, 20, 30. I mean, it just, that just can't, is that right? It can't be right.
It can't be right.
It can't be right.
We're talking about people's time that's being transacted.
Yes.
There's no reflection of the LOI or the time.
Absolutely. I've just put one axis up here because that was
not
possible.
transacting the stock like it's just.
You're absolutely right. Because there's not just one axis that you want to look at this. I just put this up for the sake of putting something up.
Sure.
But it doesn't matter what you look at, by the way. It all looks like this. You could pick any metrics you like, and it doesn't look wildly different. The other thing, look at these horizontal stripes. $8, $10, $6. Yeah, that's ridiculous. Yeah.
It must be like a 2 hour survey.
Yeah, or it'll be wrong.
Or it's error.
It's an error. The IR won't be there. Yeah, exactly. So, has anyone been to one of these charity auctions where they do a silent auction and you have to write down your price for things? You know, when you go. My wife always gets really, really upset with me when we go, and the reason why she does is because I bid $51 or $103, and I can't help it. I just can't help it. And why do I do that? Because if people are bidding roughly $100 at $103, I'm going to win the auction. Never bid on a round number. I mean, that's coming from a trading background. I can never bring myself to bid on a round number. But look at this. You used to see this in shares, by the way. A lot. You'd see people bidding $50, 51, or it's pretty much gone away. And it's gone away because the investment banks built these automated trading systems to pick off those prices.
Yeah, they did.
So So that's sort of gone away in the market. I think it'll probably go away here. I mean, why, you know, should this be at 4 or 405 or some other number? It's not. That there's got to be a better figure to put these things on the market at.
This reminds me of video games. Anybody remember Pong? Remember they actually play Pong? Yeah? Okay.
It's all over.
Has anybody seen the last Call of Duty? Can you even tell that it's not real? No. That's where this is going.
Yeah.
Right?
And right now we're at the Palm station.
We're at Pong, which is really good news because it's going to be fun.
Yeah. So I love this part. I love the inefficiency. I mean, this is fantastic for us. Please just
opportunities must be huge.
please just try. Just please carry on. I mean, because this is fantastic. But you know, I don't expect it to last. I mean, you know, you've already ruined it with Reach. So you know, I may as well.
We haven't released the APIs yet, so it's still
Okay. All right, I'll get another couple of weeks. This is complete. So this is actually where the money is, right? This is where people get paid. Look at
0%.
yeah.
50 cent
Look at the difference in the pictures, right? So now we understand. Look, this is where it's getting done. Yeah, the high IR, low price. That's where people are executing their business. That, you know, there are probably some errors in there too. I think there are the odd one, but the odd one pops up.
Do you have this data though at the LOI side of things, what you're saying? Because that's a much different indicator with the data sets.
It looks
IR.
it looks the same.
But looking at it from the perspective of the end user as opposed to the seller.
Yeah. Yes. You could write LOI there, and it would look. It looks very similar, except that this all ends up being, you know, down here because people prefer the low LOI ones. But it does look very, as a picture, it looks very similar. It doesn't really change. It still is looking pretty inefficient. So what does this tell me? Because in the end, for me, on the supply side, I want completes. That's how I get paid. That's how I pay my users. So this is telling me where I should focus my attention. It tells me about. I haven't put names against any of these dots, but some suppliers, some buyers of survey are different from others. So it tells me a little bit about that. There's an interesting hole in here. It doesn't show up quite. December was actually a bit bigger of a hole, but there are weird artifacts in here, and I'm not quite sure what they might be. But you know, this sort of middle range of IRs, there's a hole where people don't seem to be able to execute those trades very well, or complete the survey. What's the right ratio in price between here and here? It can't be that. But
Is this what the buyer puts in, or is this actual?
no, so the buyer puts in their offer, as it were, onto the marketplace, and then people on our side of the market try and do those surveys.
So that 100%, is that what the buyer?
The buyer has put that
Bid
in.
IR or the actual IR?
Yeah, exactly. That's
It is the.
I'm just curious.
It's the bid IR.
Did I?
Yeah.
So it's what the buyer thinks it's going to be before it starts.
Yes.
Or they?
And
Lucid model does.
yeah.
Lucid models are the difference between Sid's model and Lucid's model in your data set. Yeah, we start with the set first.
Yeah, it's slightly different. We've just sort of mapped them over, but we actually, when we look at it, we don't actually look at them necessarily side by side in that way. I just put them up here because, and the reason why it's the bid IR is because if I'm deciding which surveys to put my users into, that's the data I have. So you know, what else can I do? I mean, that's what you have to predict.
Would you suggest that it's actually the production or the field incidents that is used in an exchange?
So I'm thinking like client incidents could be 90 by the time they finish, oh, but it's only Gmail accounts and it's only this, it's down to 20. So what would we really, in order to be more efficient and effective, we want to put in a deal.
I think that's right. Yeah. Because that at least allows us to say, okay, how do we deal with this survey properly?
Right.
Well, I think we all see that the field incident changes over time. So the start of a survey instance versus the end of a survey instance can be very different.
Exactly.
So there is no survey field instance necessarily.
Well, after a certain amount of time, it stabilizes, right? But I'm thinking more about as we move into the digital age, and there's more and more digital stuff we're trying to do, we see more and more constraints that are related to technology. They're not related to a client incident. And
Gmail account,
like it's.
Or it has to be on the phone.
It's like there's a number of things. Flash. Okay, we don't know that one. That one's
that's a whole other discussion.
But this is the sort of thing that we're starting to see more.
But there's technologies that can control that too.
It's some of it is. I used the Gmail. That was actually one of them that cut down quite a bit. But it's these sorts of things, and we are having to do, I would say, a bit more client education.
Yeah.
To help them understand, they'll put a term on something and not even think about what that actually does.
Yes, exactly. But as this becomes more efficient, it's gonna become important, because if you put the wrong data up there and it starts to not be what we expect, we'll stop doing them.
And that's the error rate.
Yeah, exactly.
The delta between the bid IR and the actual IR is actually error.
Yeah. So, we're trying to track all these things as they come through in real time, in order to, our job is to match people to your surveys, and we want to do that as accurately as we possibly can, because that's good for everybody, right?
Exactly. As a buyer, because we buy out of sample. For us, it's really helpful to get to a better system where we match, right? Because ultimately, respondent engagement is about matching.
Exactly.
So
exactly. And this goes back to the 90% fail rate issue, right? That's so my contention in this is, and I'm just slightly stretching a point with the correlation thing that we showed in financial markets, but my contention with this is as you get more transparent, quality sort of has to improve, because otherwise you're going to be an outlier in the marketplace.
You mean transparency, like if your survey sucks, you're an outlier in the marketplace?
Yes. Yeah. Because I'm going to try and do the ones that I think I can do, the ones that my panelists can do, and I'm going to try and pick those as hard as I can, because that's a better experience for them. They're going to come back and do somebody else's survey tomorrow. I just thought I talk a little bit about how we model quality from our perspective, which is, can a survey be done? And so that's the top item: correct data. Is it right? We still get an awful lot of surveys where the redirects don't work, and that's really painful. That's probably the most painful error we have, because someone has spent 10 minutes, 12 minutes, 15 minutes in a survey, and then it breaks right at the end. They go nuts. We get a support call. We have to go. It's an expensive. That's an expensive failure. Sorry, say. Sometimes. Sometimes.
Yeah, or if something happens in field and redirects break, and they didn't know.
And they didn't know. Yeah. We talked about mobile till we're, is it compatible? Even better, is it mobile optimized? Because then actually, and the reason why, look, so we care about this obviously because our panelists deal with this stuff all the time. Why should the buyers care about this? And we talked about this a little bit. Why should they care? In the current formulation, why should they? I think as pricing gets more efficient, the people who don't care will end up having to pay more for their service. It just has to be. So I don't think it's going to be a sort of, we're going to turn off the tap, we're going to, whatever, we're rebelling. But I think there will be price impact. And even better, it's amazing how some surveys users really love doing and some surveys are just boring. And sometimes that's just the nature of what you're asking, but it doesn't have to be. So we actually ask our users when they crash out, why? What went wrong? And they can report them. And we do that mainly so that we can not put people into things that aren't working. And there are the answers.
What is stuck?
Stuck means, it probably means mobile incompatible in reality, but it basically means that the buttons went, the buttons went off the page, or that they couldn't quite, the zooming didn't work, and they couldn't quite get it. It's that type of thing. So those are the, and just to give you an idea, that's our demand. So 60% of our demand on a daily basis is mobile. That's growing.
You mean the supply you have to offer?
That we have to offer.
Yeah,
we have to offer. Yeah.
And what does it look like on the other side? What surveys are offered?
You guys prepped this beforehand.
Amazing, isn't it? We ask all the right questions. Yeah. I mean, we flogged it to death, but that's the reality. And we get spikes in traffic to our site. We get a spike in commute time. We get a spike at coffee time. We get a spike at lunchtime. We get a fairly broad evening spike when people are probably, if they're like my daughter, they're on 3 devices at the same time.
Only in one market.
Say again?
Because you're only in the US market,
No, per market. It's the same in every market.
I'm working a lot in Africa. Same exact spikes.
There you go.
Cool.
Lunch hour, traffic, lunchtime.
Yeah.
So people in traffic doing surveys?
They're pooling, surely.
It's a global.
Yeah. So
That's what I do on my commute. Take surveys.
But look at where the buyers are putting. This is really heavily driven by what's available. This orange line.
What is it? I'm sorry, what is it?
So the volume of stuff that gets put on the market is a huge spike in the evening. We've got these big empty spaces. We've built, Patrick has built this shiny machine for doing surveys automatically, and for half the day, it's not being used. The volume on the market is much, much lighter. Again, if you're a buyer, putting stuff up in the morning is going to be cheaper than putting it up at 5 o'clock at night. Because we're keen to, we have people who want to do surveys now.
But then probably throughout the day you communicate with your client and at the end of the day you give a solution.
That's right. Yeah, I know. And if you put it up at the weekend, you'd probably be able to charge a third the price, because there's much less volume. And we have this machinery that's running 24 hours a day. We have weird users who come on at 2 a.m. wanting to do surveys with very little to do. So anybody has any? I'd love to answer any questions that anybody has, or comments or thoughts around any of that.
So if you could wave a magic wand and fix one thing, what do you fix? You only get one.
Late terminates. Late terminates. If there's ever a way to make people never want to do a survey again, it's a late terminate.
And how long is a late terminate?
We count it as anything after 3 minutes. often up to 3 is qualifying stuff, and again, that's painful. That
Back to my earlier question, so you have nobody testing. When somebody programs a survey into your tool, and goes out and filters.
well, don't forget we're plugged into we're plugged into Fulcrum, we're plugged into Cint, we're plugged into 2 or 3 other
But I'm
things.
saying we would still test it.
So that in theory should mean we shouldn't be getting these, right? But every now and again.
If you have a late terminate,
But-
you can't have that. We
but-
have rules on it.
But then the answer is you should be able to charge. We will do stuff at a lower price if the error rate is going to be much lower. We just will, because otherwise I have to employ hundreds of people who are dealing with irate people. So there you go. Yeah. So, but that's the reality, right? That's and not everybody does what you might do. But yeah, so I mean, late terminate, it just kills a panel. It then costs us money to either recruit or to try and fix the problem, and that means we have to charge more in the end for the surveys that get done.
Question.
Yeah.
And it's back to the mobile optimized, right? And it comes back to the late terminate.
Yeah.
Why should the buyer care though? It's not their panel, it's not their member. How do you instill
I think
the care factor that even though it's not your person that you recruited, it should bother you the same way it bothers the panel?
I think in the end it'll only come down to the fact that the pricing in a transparent marketplace can differentiate. And so I don't think it's going to be like I don't think it's going to be a tap turning off where we say, look, we're just not going to do these anymore. But I think over time, if you're constantly having to pay 20% more to fill your surveys, eventually you've got to hope that would start to matter.
It's not just that. And to kind of answer your question, you have to, and we see this when we do desktop only surveys versus the combined. You have a whole different person on a desktop, attitudes and behaviors than you do on a mobile device or blended sort of response. So your data is just completely different if it's desktop only versus if it's multi-device.
See, I have a question that though. I know research has been done, but I have a question because is the experience created equal? And I don't think there's enough data on equal. The survey experience on the desktop and taking it on mobile is different, and therefore you're getting different data. But if the experience for mobile was created in the ease of use, and you have enough data on it, I don't know. I would question. I don't think it's going to look a whole lot different. And if anything, again, I know we're a lot of researchers in the room and a lot of representative. And what does that mean? I mean, most people I know are on the phone all day long.
Yeah,
So where is the rep? Is it in the desktop because it's been done for 40 years, or is it on the mobile device?
we don't see a huge difference between PC and smartphone. We build our surveys for smartphones, and but in advertising. So things that are about the device themselves, then you do see a difference. And so we've had to educate on like, okay, just like you're not going to, if you were never going to deliver it on a TV screen, then you're not going to test it on a TV screen. You're going to test it on the screen you're going to deliver it on. But those are the only things that we've really seen. We did find early on, and I think probably there still is some of this, you get lower incomes, you get more Hispanics, so you actually get a broader part of the population. But I agree, I think that at least in the US and North America, it's 50-50 on males and females on smartphones, like even all ages are on smartphones now. It's just much more representative than it used to be.
Yeah, I think even from 5 years ago, right? I mean,
Yeah.
it's changed.
Yeah.
Everybody.
Yeah.
You probably get better spread on smartphone than you do on laptop
Yeah,
now,
and
right?
this is what we tell clients too. So we talk about operational implications, but we also talk about representativity. And if you're going to stay in one dying vertical, you're going to lose representativity.
Yeah.
It's just the way it goes.
Yeah.
It's a shame because but for those that, again, there is research done, like there's somebody made a comment to me today about response rate on mobile is lower than desktop, and I'm like, no, it's not. Response rate is not lower on mobile, and if anything, response rate on mobile is higher, and it could be even more better, and when I say more engaging, better engagement. If a survey is designed properly on mobile, it is one of the best experiences, and we've heard that, we know this, we've seen it, we've heard it, and so you can say the same thing.
Yeah.
It's actually a much more, it's a better experience.
It's a more intimate experience, right?
Exactly.
And actually, it's more. So people actually relate to it in many ways better, I think. But we're still, I mean, you can see our numbers. They're not great. I mean, a lot of the stuff that comes through the pipe is hard to do on mobile still.
Geography concedes that though too, so it goes back to one of the first to wrap that. You go to APAC, it's all mobile. They do not use that.
Yeah.
Bean is the same way.
Yeah.
If we were just doing PC and BNAM, we never did.
You get it. Yeah. So that's forced a sort of hop right over the top, right? Straight to mobile. We'd love to. I mean, we'd love to be there too.
Yeah, that's actually one of the things that kind of stuck out with me. It's like the developing countries have skipped mail and phone and everything, right? Just on straight.
All the way straight.
Yeah.
Yeah.
But I think the other thing is that for me, in my perspective, clients, if they want to be mobile optimized and mobile compatible, they have to sacrifice certain question types on the question of plan,
Yes.
which they are not willing to do.
Yeah.
Even though they know that mobile is much better, they know that they cannot use that particular question type.
Yeah.
For mobile,
And if you look at my 16-year-old daughter, she will go down her Snapchat and respond to 50 or 60 different streams of information in about 30 seconds. Right.
So we use the mobile because they don't want to move away from historical data. Like, it's time to break that.
Yeah.
Move forward.
But that if you're 16, you are used to being able to answer questions and respond incredibly efficiently and quickly and in an engaged way. They want to do it that way. So I think whoever does this is going to have a massive competitive advantage.
And also, when we talk about data quality, just the question, where do you think you get better data from? 3 questions at a time? 3 questions. When anybody questions the validity of the data on a 3-question survey, probably not versus 30 questions. Now we start questioning why. Because people don't have the patience, but if you really want to get the data, there are so many cool opportunities, and I think embracing mobile allows you to do it with Swipe and some of the features that you do just could allow for a whole new world.
Absolutely.
That's why Google doesn't have it.
Yeah. So our abandon time in mobile is about slightly less than 60% of the abandon time on desktop. So that's the level of patience that people have on a mobile device. So I mean that goes to that. Exactly.
My prediction is that as price discovery becomes more available, then suppliers are able to better price better performing surveys for whatever reason. It could be mobile optimized, could be a great survey.
Yep.
And those clients that want to use expensive things like super duper weird questions and deep LOIs, their cost will go up.
Yes. I think it has
We're
to.
this weird transition that programmatic is, let's be honest, programmatic has driven some prices down. And in theory, that has to stop momentum at some point. And then the quality of survey experience across all these vertices starts to be very specific in how you price, right? And so, that client that wants to be asked the expensive questions, the weird question types on desktop only, will then be priced.
They'll be paid. They'll pay. Exactly. Because but right now, you can see this is all over the place. So there's no signal at all. There's no signal back to the buyers because they get stuff done, whatever, wherever they put it in. If this starts to normalize, which I think it will, then at that point, it does become a more interesting conversation.
I agree with that. The reality is we're in the early stages of this.
Yeah.
Right? We're in the early stages, and suppliers are starting to work in programmatic betting, and suppliers, depending on which stage they are in the game, right? They start from the first step on the ladder, then they go to 2, 3, and they just get smarter, and then they start collecting the data. They'll know where to go, who to navigate, who to send to, and who's like, okay, this just doesn't work.
Yeah.
But how do you, like as a buyer, so sellers are setting their prices based off of parameters that disincentivize the things that you're trying to drive for. So as long as you just price off of, incidence rate and length, versus provide incentives to say, like, okay, it's actually less expensive if you it's actually much less expensive if you never go over a certain
there's no language for us, right, to talk to you in that way, and I would love to sort of try and create that language.
What do you mean with it?
Well, so we need a language that says, if you can give me an A-star quality survey, you'll be priced at minus 20% or whatever. If it's a B plus, it's going to be because it really matters to us.
Quality of survey.
Well, it's quality of survey in that it's something that the users want to do.
Right. Well, quality means in terms of the value of the survey experience to the user. Right?
Yes, exactly. So we can't put that on a numerical scale at the moment, but that's something I think we should try to do, because I think that gives then a reason, firstly a language for us to talk to each other about what the survey is going to look like, but then also a way to reprice stuff. I think that's really important.
Internally,
we do it internally. Yes.
Measure the quality, or let's say value.
Yes. Less. Yeah.
The value of a survey, and there's some numerical ranking of that. And every supplier has a proprietary method of ranking, so therefore there's no standard way of communicating value across. Yeah, exactly. And if we had a standard, then maybe it would be then possible to have that conversation. I think that's a really good point.
Well, if we use Mindy's idea and we price on the start model, I think that's a pretty clear, agreeable standard. There's no ambiguity about what's it going to take to get, It's very tempting to talk about the stock market when you talk about programmatic sample, but trading stocks and trading certificates are really, there's a lot of differences. There's no buyer's remorse or reconciliation concept that go out 2 months beyond the transaction. The transaction happens, it's done, nobody returns the stock. But it's just one example of one thing that's different.
Yes.
It was time to kill reconciliation.
Well, the reason these charts are all over the place.
Well, you shouldn't be able to reconcile a start, right? It's like, that we agree upon a price for a start, we've got to a start. What's the reconcile, right?
So the reason your data here is all over the place, and this is an area for a simple improvement that could be made that will save buyers money, and suppliers would send more to, is if we can trust the input, the data that you're putting in, is that really 90% IR 3 minutes or not? And today people are going into the platforms and just throwing in whatever's the quickest route. Somebody must have written code at a company to just say, just put everything in at 20%, right?
Yeah.
And what you're doing is you're actually, even though today I think buyers think they're, you might be getting a deal, right? If you're getting a deal on one of those completes, 2 completes, you're really could be getting a much better deal if the accuracy behind your bid IR is the actual. Because people would sell it much cheaper.
If that was the CPI, if that was cost per start, you would probably see a straight line.
No, I think you would, because clearly you're incented to put only things on that are going to complete.
And that's more like a stock exchange model.
Yeah, yes, it is. But I mean, we are where we are, so I don't know how how do you move.
Is there an equivalent in the financial markets for something that's more like a survey complete, where there's some ambiguity about whether it's going to,
So actually, so it's an option. So actually, which is sort of what I did in my old life, as it were. So there's an optionality here where the user is spending some amount of time in the hope that they will get a complete, and it may work or it may not work. So it's like an option, and you can price those. So, I mean, I think you're always going to want to pay on complete because you want to make sure the user does actually go all the way through that process, right? And there's some incentive to
starts to play devil's advocate to his point, your point, and then we're talking about it puts the pressure back. And this is why it's never going to happen, because it puts the pressure on the survey designer.
Yeah.
That's the way AdWords works, right? It's the key thing. So
it's never going to happen.
That's the way Google AdWords works. You have a horrible landing page if you're paying $1 a click. That pressure's on you to make that perform. So
I don't think there's anything wrong with putting pressure on programmers to design good material. From a user
Is it possible, in a way, to actually not force people to grade questionnaire quality, but have some sort of a, dummy test data to be do testing. And then basically, even regardless of what the buyer has put in the system, then
yeah.
you run your data testing, you already automate.
We've thought about that. It's sort of harder than you'd want it to be. You know, I'd love to be able to do that, by the way, and we have thought about that.
We thought about it too.
But the question is, to run an automated bot through
to know
matching.
what it's really, so how do you validate it?
Yeah.
It is the key thing. It's like, what do you validate against success in market? Or, you know, like this was that was the hard thing. We could measure everything in the survey, but then how are we really valuing?
Yeah.
And so I don't know if we've really thought through that whole thing, because it does become like just if there's no reason to do that exercise, then you sort of it's hard and we're going to move on to something else.
Also, you can change and bring them, so you can run the bot right to the experience and bring them to like
It's a different,
I
mean, we effectively run sort of human shields through the surveys. I mean, that's what we do. You know, we run fodder through the surveys, and you know, so they are our bots, and then we try and pay them back later.
One suggestion that I would make, and I love from the buyer's perspective on this, like folks that are buying a lot, this is not to, you know, I think about Uber, right, and the concept of the rating system, which is not a one-way rating. The way for rating to work is a two-way street. For years and years, and even today, right, we've been quality ranking, who is continuously the bad one? Who's continuously or good one, but who's the one that's continuously rated for their delivery? It's one-way street. Would you be okay as a buyer, all buyers, for a two-way street to be implemented? Buyers are graded as well for these late terms, mobile, whatever these things are. It's not that you're bad or good. It's not, but you're graded the same way suppliers are. How?
From the response, you mean the respondents are grading you?
The panel.
The people going through your survey are grading.
No, us suppliers have a grading system because we have all the data, all the data sets. We have the data. Would you be okay with that, or does that create all of a sudden? Oh no.
Oh no, I think that's actually a really good idea, because it is a two-way street. Like we need to buy sample. It needs to be quality sample. And we need to make sure that we follow your rules. So there's some things, you know, like Facebook has rules about you can't ask these questions to our people. You know, that kind of stuff we need to make sure we're very, very careful. We're following all the rules. These are not our respondents. We cannot treat them any way we want to treat them.
And there are regulatory issues too, right? Particularly coming up now around what you can ask and what you know. There's a whole Pandora's box, right, of stuff.
But in my mind, I mean, that's exactly right. Like, we have, what is it, like 6-month meetings with our suppliers regularly where we talk about this. What are we doing wrong?
A lot of really good buyers do that. I've done this for a very long time. One of the things that I think about from a grading perspective on the other side, on the buy side, is how not only how good is your survey instrument, but how good are you at estimating what the metrics are going to be, right? Like, are you posting a constant 20% IRR and ends up being 4 all the time? Is that a pattern of behavior? Is your link of interview posted at 10, but it's really 25? Right.
I think that reciprocal data is probably one of the few things that could serve to actually change behavior. Because the type of behaviors you're talking about, everybody theoretically knows that what they're doing is a bad thing. But they kind of save it for the next person, you know. And the ability with, you know, quantitative data to kind of show as an organization, you know, how you really stack up against the things that we would all agree from an industry perspective are important, I think would be impactful.
There's issues with that though, because I'm a eye tracking company, and we have the market researcher as a client, and then we go to you guys, and we have the layer of eye tracking data, usable data we can use, which can be very sensitive. So, you know, we might have a lot of people start screening out because they're not doing the eye tracking data correctly, or it's surveyed from the market research, they program it in a certain way that's shitty. And, like we're getting, you guys probably think we're a bad buyer, but, we're trying to do whatever we can to be a good buyer, but it's just, we're, like you said, there's errors, right? Because you have a client with...
Yeah, there may be how many layers.
And they're trying to blame it all on us.
Yeah.
Because our sample wasn't working right. I'm like,
See, to me, this is why programmatic and automation is awesome. Because guess what? How easy would it be to add another return in the call to say, this is no good because it's people, the respondents are not viewing, or it's sensitive to eye tracking. You can easily add that component into something like this because today, right, everything looks the same. Your term, why you term?
Yeah.
Term here, and who cares? Like, we're just going to term you. So the data's not being fed back to suppliers. So yes, you're just going to get, in the eyes of suppliers, the buyers will be bucketed as just another one of those companies that just term you for no reason. But that would be, suppliers would love that level of information.
Absolutely, because then we can work with it and try and make it work.
Right.
I mean, our incentive is to do as much volume as we can, right?
Yeah.
We want the complete.
Fulcrum, because they manage the suppliers directly, I guess, more so than I'm just going to you guys and learn on my surveys there. So.
Yeah.
Well, this reminds me of the old telephone that he had on the screen first, and then later that big visible screen of all the data moving back and forth. The more transparent it is, the more information that's available, the more informed decision can be made around what gets programmed into the API and how it's handled. And it just gets better and better and better.
Yeah. We when we ask our users to do some of those video capture surveys, or can your child come to the screen and answer question surveys, we flag them up front because not everybody is comfortable with that. And if you flag it up front, then people know what they're going to get, and then you're going to get a better response. But if we have the information, we will put it out there.
The good news is, I think, again, suppliers can do a lot of really cool things. Although over the years they've always been, it's bad. There's a lot of cool things, and I think because of technology, the ability to share the information to the supplier and what you need would allow for things that have never been done before. They have been done before. It would have costed you $70 to get done. Today, it could get done at a very fair price, just feeding that information to what was it, Jonathan?
Yeah.
What Jonathan just said. A simple flagging system for suppliers to know this is a video-related thing. It's just not meant for everybody. I mean, people won't bother sending in this people that have no interest in being recorded. I mean, I don't mind taking a survey for my true blue points, right? But if they're going to send me a survey that wants to record me, I probably don't have an interest in.
It's interesting,
but like a human being.
But some people don't care. I mean, it's an interesting thing.
Disclosure will get you a long
Yeah.
Yeah.
And they also feel like they're being treated right. So, they'll come back again.
How cool is that?
Great. Yeah. Thank you very much.